Now, as we pivot to the Fed and inflation, we wanted to introduce a term, disinflation. So disinflation, and I'm just going to read from Investopedia to make it easier, and because I think they do a good job of simplifying it, is a temporary slowing of the pace of price inflation and is used to describe instances when the inflation rate has reduced marginally over the short term. Unlike inflation and deflation, which refer to the direction of prices, disinflation refers to the rate of change in the rate of inflation. So all that is saying is that the rate of change of inflation is slowing, so we're not getting price increases to the same level, but it doesn't mean that we're getting deflation, which all that means is when you go to the grocery store, deflation says your prices are going down. Inflation says your prices are going up. Stagflation says they stay the same. Disinflation says they stay the same, but there's some change of rate of change. So let's take it in terms of numbers. So if pasta was $1 6 months ago, and then 6 months later it was $2, you have inflation of that dollar. Now you could see that over that 6 months you went up a healthy clip. Now disinflation, stagflation says it stays at $2. So you never get back to where you were. Inflation says it goes from $2 to $2.50, or really $2 to $3 over that another 6 month period. Deflation says it goes from $2 to $1.50. Disinflation means that it doesn't go from 2 to 3 in the same time frame. It could go 2 to $2.25, 2 to $2.15, even 2 to $1.90, $1.95. So you're just getting this waffling back and forth within this construct. So we're not going up or down. It's just you're sitting within this level that I think is a very interesting period, which is why I talk about that piece of the disinflation, because I think that's a good way to describe the rate of change. The rate of change has slowed. We've been talking about this nonstop, which is why we believe stagflation is the next stage, not deflation, because you have these push and pull, and we're going to talk about them through segments 2 and segments 3. So when you look at the Fed rate expectations, when you look at the meeting, right now the view is 465. If you look at as we go into the other regions, into the other periods, there's a higher Fed rate expectation, which is, again, going to see more and more of this push higher, which I think is going to be very important in general. Now, we holds true to the fact that we're going to be at 5.25% next year. That's our view, is that we are going to get to about 5.25%. And then we're going to stay there. And that's where we're going to stay. We're not going to go up. Because as we showed in last week's episode, which I personally liked that episode a lot, looking at the rate of change of the Fed funds rate, how that's going to continue. But when you look at the market, there was expectations that in the equity market, that rates were only going to go up 25 basis points. The Fed kept to their 50, which was very much... they showed it, the bond market priced it in, but it was still a bit of a shock. And that's the problem, is I think investors are being pushed to understand, look, the Fed's not going to adjust. The Fed is not going to change things holistically, and we really need to address the fact that that is going to be the case. The debt will rise significantly over the next decade because we're raising rates, and the Fed and the Treasury has to roll its debt. We continuously just issue new debt, but now when we look at where things are, you can continue to see these movements. You continue to see these different pieces where our costs are going to go up. So the interest spending is projected to rise to a record level. This is going to make it very expensive. As this gets expensive, it just increases how much the Treasury has to pay. So not only are we rolling our old debt, we're issuing new debt. So, but you're doing both of those at a higher interest rate, which is going to compound on itself because we're still spending more than we're making. We're still rolling debt. So the interest expense goes up. And as the interest expense goes up, it means that you have to roll a bigger tranche because you whittle down your revenue faster because you're paying interest expense. And this is when you can start to see things balloon if you don't get in front of it, which is why we talk so much about the importance of the government starting to pull back on their fiscal spending. You need to see an adjustment. Otherwise, we're just going to print, essentially, indebted ourselves into oblivion, which we've seen multiple times. U.S. market implied terminal rate is kind of bouncing around right now. They're saying at 4.85%. It's gone up a little bit since that. Again, there's still this view that they're not going to hold at that 5%. Market pricing for the Fed funds rate change after the Feb 2023 is at about, let's call it a certainty of a quarter of a basis point. And for us, we still think that it'll be a quarter. We don't think it's going to be 50, especially based on some of the recent data from inflation, the recent data that we've had from retail sales. We'll see some of that slowdown, but it's still going up. The target is at a minimum of 5%. And you might say, well, why? Well, just look at where inflation is. Look at the rate of change. It's still sticky. It's still positive. And that's when you have to look at month over month versus year over year, because month over month, you're comparing it to last month. And then next year, then on a year over year, when you look at things in general, year over year, the comps in 2021 are hard. I mean, we had a huge acceleration. So year over year, things are going to look better, but month over month, which is what you and I see, that's going to get worse, and that's going to stay elevated. And yes, it's not going to go up 60 basis points. It's not going to go up 1%. It's going to go up 0.1, 0.2%, which isn't huge, but it's still an increase. And that's the rate of change that we continue to see. When you look at the leveraged loans, and these are important things because the leveraged loans are where things are and which credits are most likely to be the canary in the coal mines. It's always the leveraged loans because they're levered. So any change in that credit has an exponential impact because you're leveraging cash flow. So if it then takes more cash flow to pay things off, to manage interest expense, that's when things can get devolve quickly. U.S. distressed loan volume, you can see just how much distress is in there, and that's where things continue to get a bit worse. The 10-year, 3-month yield curve typically troughs at 0% to negative 1. And when you look at it in general, we think that there could be some additional downside, and that's going to be something to watch because that is a concern for the Fed. Another big concern for the Fed is when you look at the Goldman Sachs U.S. Financial Conditions Index. Conditions are actually getting looser. That's the last thing that they want. They don't want things to get loose. They want things to remain tight. And here you're starting to see a little bit of this adjustment. That is a problem that they want to address. And at the same time, this is also showing that people don't believe them. And the Fed needs to maintain a certain level of conviction. And you have to believe what the Fed is going to say because the Fed is really moving things on faith. They have market structures to keep rates where they want them to be, but there's a lot of faith that is put into them and direction, which is why they are able to move markets the way they are. This is them calling them out, saying, you're not going to stay where you say you are. You're going to yield, and that's going to be the biggest thing that they're going to want to get in front of, which is another reason why they're going to continue their path. The single most important problem for small businesses remains inflation. Inflation is still impacting everything along the supply chain. So net percent of small businesses citing inflation as most important problem ticked down slightly in November, but share is still high relative to history. Quality of labor and taxes become less of a concern. So still inflation is the driving force, which is why the significant number of FOMC officials still see upside risk to core PC inflation and are reporting higher uncertainty about it. Because if you're concerned about inflation at the small business level, it's because you see your cost, you see your labor, and you're like, well, I'm going to have to raise prices. But if I raise prices, then that creates that cycle effect and that spiral that you see on wages, which is why the Fed is sitting there saying, we're uncertain. if we're uncertain, we're going to have to act like the worst case scenario is possible, which would be an issue with a wage spiral, inflation not reacting the same way. And as last week, when we compare things to 1973, 1974, 1976, 1980, they're trying to walk a path, which I think they're doing a fairly good job at walking, of being a little bit less than 1974, more aggressive than 73 rather, because they started to cut rates in 74, which was too soon, which created the need to raise rates again in 76, but they did it too slow, which then there was a panic at the end, and they gunned rates, which then created this uncertainty, which Volcker tried to get in front of in 1980. So that's why they're looking at this, and we're going to see these rates go up. We're not going to see a cut. When you look at PPI in general across the board for truck transportation, deep sea water, the divergence in transportation components of PPI inflation, we have air, which is white, continues to roll over, while truck, blue, deep sea, orange, and rail reversed higher in November. So you're still seeing stickiness in these costs because their labor is more expensive. Think about a rail. You have to worry about steel for your rails. You have to worry about crossings, bridges, reinforcement. Your CapEx costs are going up. Your cost of capital is going up. You're going to try to recover that cost by charging people more. So as your cost of business goes up, then you pass that down, and that's sticky. That is not something where, UNP says, oh, well, I got that steel for, 20% off, therefore I'm going to give Target, a discount of 10%. Like, that doesn't happen right away. It takes a lot of time to build that up, which is going to create a lot of that stickiness, which we're going to show you sticky inflation in a moment. But then when you look at consumer price index for all consumers, food away from home, which is that purple, and then food at home, you're still seeing this increase. It is flatlined. The rate of change has gone down, but that's what we spend. You and I spend every single day. We buy food, whether it's at home, whether it's takeout, whether it's at a restaurant. That is a real number that is impacting everyday Americans. But as we showed in segment 1, it's not just Americans. It's the world that is seeing this problem, which is why we're seeing spending going to slow. We're going to see that slowdown in global consumption because of things like that. Which is then when you look at, the U.S. Treasury. The U.S. Treasury deficit or surplus, the deficit is accelerating to the downside, and we're following very closely in 2023 with where we were in 2022. For those that don't understand, this is fiscal year. The fiscal year is, as you can see, is in July, which is why it looks like that. U.S. interest payments are rising, and you're seeing that pressure. You're seeing that. So all of these things are happening. The Fed can't pivot. They're not going to pivot. They've been very clear they won't. So that's going to push interest payments higher because rates are going to go up. You're going to see more. It's going to be more expensive, which is going to accelerate the deficit because you're going to have to pay more into the market. I mean, we're not talking like, oh, you have to pay an extra $10 a quarter. We're talking billions, like hundreds of billions in interest expense that has continued to go up over that time frame. And while this is happening, the real net worth of the household has fallen. It's back down to trend, and based on everything we've been talking about for what it feels like months and months and months, years at this point, there's not a lot to see that real net worth pop higher. And then when you look at the GDP, when you kind of break it down, we have a demographic problem. We have a labor issue, which is why we've talked so much about we're not going to have a Great Depression. Great Depressions require, I think it's over 20 or 23% unemployment. We don't have the demographics for that level of unemployment. We still have a low labor force participation. We still have high unemployment, and that's going to hurt us. Given the pace is slow, we still have a decent amount of immigration, where other areas like China, where you're seeing that labor spot drop off quickly, they don't have a lot of immigration. They don't have a lot of new people coming in. They have a demographic problem, which the U.S. has, just not to the same degree. And it's important to look at that when we're cycling out and understanding some of those different flows. Consumer credit month over month, the survey was for $28 billion, came in at the actual of $27.1. we're right back above trend where we were previously in October, and as we know in November, it continued to go up. Again, the rate of change is gonna vary, but it's still positive. People are still adding credit because savings are gone, and people are now relying on their levels, which is why revolving consumer credit month over month came in at 1.17 trillion, which you can see is blown through pre-COVID, well above revolving consumer credit, real revolving credit. So the real revolving credit is interesting because it's factoring in inflation. So you're not borrowing as much, but your money isn't going as far because you can see that huge disconnect given the level of inflation in the market. So even if we get a disinflation, the distance is so significant that this isn't going to end quickly. Like, this is not something that's like, oh, this will be a quick snapback. There is a lot of problems within this that are unfolding. Consumer interest rates, credit cards assessed interest rates surging higher, coming in at over 18%. 30-year fixed mortgage rate, 24-month auto loan. All of these things equate to more pressure to the downside when you look at consumer interest rates, when you look at things impacting the consumer. So then undervalued at prevailing mortgage rates, you can see where the mortgage rate is and where the value of homes are shown to be, which is why, again, we're going to see more of that pressure to the downside. U.S. household net worth as a percent of disposable income has been rolling over since Q1 of this year, but as of Q3 of this year, it remains elevated. But the surge higher, you can also see a surge lower. And the problem is we saw it in during the great financial crisis. You saw it right as we got into COVID. We expect to see a sizable drop, which again is going to be a huge overhang. And some of the key pieces to that is the 16% trim mean consumer price index. It's rolled over a bit, but look at where it is versus historics. Then you look at median consumer price index, it's gone higher. So you had one that dropped slightly, you have the other that went up. Obviously, as you can see, the rate of change has slowed, but sticky price consumer index went up again. That is what they want to address. They want that to go lower, and it's just not getting there, which is why we believe that the Fed's going to remain in their trajectory. US CPI month over month diffusion index, there's less stuff going up instead of over 75, almost 75% going up over a 4% annualized. It's 60%. Now that's going to come down because you're going to see some of that slowdown, but there's stopping points. There's a limit for where some of this can go, which is going to be a bigger and bigger issue as we go through the different timeframes. Then when you look at consumer price index, this is one of my favorite charts only because when you look at it, you have to look at going back to 1945. You can see that the deflation or disinflation that we've had doesn't even register. Like we've had a consistent move up, and we've highlighted it at different times. But inflation is a tax on the poor and the middle class. So it shouldn't be a surprise that as inflation has accelerated, the middle class has contracted, because it's a harder and harder to get above this level, this terminal velocity. And now you have this massive spike in inflation. The rate of change can slow, but we need to have a reset in order to get some of this explosive growth over the next few years. So then when you look at U.S. Small Business Survey and core PCE, so when you look at core PCE is still elevated, the share of small business expected to increase prices has come down, but it's bounced back up. And look at where things are. Things are still very elevated versus historic. So sure, the share of small businesses, which is planning price hikes, was unchanged in November at 34%, still largely above long-term average. So yes, core PCE could come down, but prices are still going up. It's just less prices are going up. Instead of 50% of small businesses raising prices, 34% are. That is still a huge number when you consider what that pain is going to be for the consumer, which is why holiday uncertainty is real. Uncertainty around holiday is not fading for small business, and shows about 85% of respondents are worried about swing in demand, up or down, impacting sales or inventory, which again is going to be an overhang for where the market goes, how people and companies manage as they go into next year. So that's what we have for you on the Fed, inflation, disinflation. In the next segment, we're going to go deeper into what's happening on the consumer level and some of those leading indicators.